We're going to look at Jankowski's rule number 5 and number 6 from the trading rules that work. And then after that, we're going to pull up the position sizing calculator that we haven't looked at in a long time. And we're going to take a look at it again for all the new people coming through the course, just to kind of give a good understanding of how do we take our technical information on the chart, where we want to put our stop, where we want to enter, how do we use that information alongside our current levels of capital to determine a max position size that'll protect us by following the 2% rule. So before we do that, let's look at rule number 5, define your risk, and rule number 6, always place a protective stop. For many of you, this is going to be a review. For those of you that are new to the course or new to my lessons, this is something that you should know inside and out. You always need to define your risk, and we'll talk about what that means here in just a moment. Jankowski put a quote in here from David Viscott, who's wrote in the Commodity Trader's Almanac in 1989. Not risking is the surest way of losing. If you do not risk, risk eventually comes to you. There's simply no way to avoid taking a risk. If a person postpones taking risks, the time eventually comes when he will either be forced to accept a situation he does not like or to take a risk unprepared. And this is, nowhere is this truer than in the markets. If you are not prepared to take a risk, you're going to be forced to accept a situation you don't like. Even if you're not trading the markets, what do you think happens when whatever currency in your country that you live in, whether it's US dollars, whether it's New Zealand dollars, the euro, the Swiss franc, whatever currency that you hold most of your assets in, even if you choose not to trade in markets or foreign exchange currencies, what happens to all of that asset wealth when your currency takes a significant hit in the global stage? Your assets take a hit whether you like it or not. And if you're not prepared for all the ways that value shifts and moves across societal, geopolitical, and economic boundaries, you're going to be forced to take a situation you don't like. So he says, it's my opinion that the single most important skill to develop as a trader is the dispassionate ability to cut losses. How you conclude is the best way for you personally is less important than having a way to do it and doing it all the time. Discipline. Of all the trading traps that have to be avoided, the one trap that will cripple any trader the quickest is the inability to know and admit when the trade hypothesis is simply not working, nor may it ever work. You bought at 20,000. You bought when Bitcoin was at all-time highs because that's the first time you found out about it. And you threw $10,000 in there, all of the money you had at the time, because Bitcoin had just run so much percent in so short a time, it was sure to go to $1 million and make you rich. Then over the course of a year, Bitcoin loses 60% of its value, give or take. Well, it can't go any lower, you decide. So you're going to buy another $10,000 worth of Bitcoin, dollar cost average down. 6,000, you dollar cost average down because support's going to hold. And then it falls to 3,200. So if you are not willing to define your risk before you enter a trade, if you don't have a stop loss in place that tells you this is the point where what the market moves against me to this amount, I'm ready to get out, accept that I was wrong, and replan for another. In war, there are times when retreat is necessary in order to win the war. You turn and you run to live to fight another day. When the market is proving a trade wrong and you have defined a point of exit, you honor it. Kyle, tactical withdrawal. Yes. Brian, my weakness is not denying myself. That's a good one to know. You can plan for that. So this goes much further and deeper, he says, than admitting I was wrong or believing I can afford to wait a little before I decide what to do, taking necessary heat until this turns around, or any number of ways of doing the same thing, justifying your inaction in the face of your equity evaporating. How many times did you have an opportunity to click the button, but you were waiting for the bounce to come in to give you an exit, and then it just kept dropping, if that's ever happened to you? How many times that when Bitcoin dropped off the all-time highs to 6,000, bounced to 12,000, came back down to 6,000, bounced to 8,000, came back down to 6,000. How many people bought every time it bounced thinking they were going to have a chance to double down, get into the next run, and catch higher? Wayne, is he writing about me? These are the setups that are designed to get you to engage in behavior which is not conducive to you winning the game. The entire goal of the market is to trick you into putting yourself into a losing position. Keep in mind, the only way the market can take your money is if you give it an opportunity by exposing your capital to an open position without defining your risk and protecting it. Carolyn Wayne, is he writing about me? No, he's writing about me. Nova, me. Every trader has to go through this trial by fire, this realization that defining your risk is what allows you to determine how much money you're willing to spend. In the beginning, Kyle, all of us in the beginning, this is exactly where I was going. In the beginning of trading, when you don't understand how a stop loss works, you don't understand about setting a risk parameter before you enter the market because you think the market, you've seen other people make money, you just want to make money, so you hope you pick the right coin that's going to go up, you put some money in it, and you wait. That's what we all do in the beginning. We have no idea of stopping to think, okay, here's my capital. Every single trade I enter, I'm going to risk only 2%. I'm going to be real strict about it. These thoughts just, when you are trying to learn so much information, all the different types of coins, what they do, what they're about, all the hype, the shill that's going on. This is the next greatest thing in DeFi. This is the next greatest thing in decentralized ledger technology. This hash graph is going to annihilate this algorithm. It's understandable that you would get into trades on things you believe are going to do successful in the long term, but have no idea yet of the volatility that can exist in crypto that can quickly turn against you and put you in a position where you feel pinned down, physically ill, sick to your stomach because your position is upside down 60%. And that was the last bit of money you had to trade that you had earmarked because you were going to put it to this, that, or the other thing that you were really counting on down the line. This is when it gets real. Had you, in the beginning of your trading, from day one, from trade one, defined your risk to 2%, every single trade that you've made, every single time you lost 10%, 20%, 40%, all of those would have been changed to 2%. You would still have that 38%, that 58%, that 68% left sitting in your account because you defined your risk smartly and backed off and let the market humbly point out the direction it was going. You fight the market, you're going to lose. He says the only reason a losing trade happens is because at that precise moment, you're on the wrong side of the order flow. Notice what he italicizes, at that precise moment. It really doesn't matter how that happened or what you told yourself in order to execute at that point. In fact, the fact is you're losing money. As long as you continue to remain on the wrong side of the order flow, your loss will continue to grow until you're either forced to liquidate if you have a margin call or worse, or you choose to liquidate when the pain of the loss affects you so greatly you can't bear it anymore. In all cases of a loss being large and unbearable, the simple act of liquidating is done when the trader has lost control of his execution. Notice it doesn't say when the trader gives up or when the market causes you to lose too much. It's when you lose control of your execution. When you feel pressured to click the button, you don't choose to click the button if you're stressed out and you can't sleep at night because you're in too big of a loss, so you have to click so that you can go to sleep and get some rest. That's not a choice. That's a loss of control. And the moment you start to recognize that and target it, you can change it. You can take control back. You can define your risk. He talks about it a little more. I'm going to skip to the end here in the interest of time. He says, whatever funds you choose to work with, make certain your risk on those funds includes not needing them later if you can avoid it. Let me say that one more time for those in the back of the room, and then I'll talk to you in a second, Nova. He says, whatever funds you choose to work with, make certain that your risk on those funds, whatever you stand to lose of those funds, includes not needing them later if you can avoid it. If those are funds that you would be in a very bad position to lose, you should not risk them. But Mike, then if I don't risk enough, I can't make enough to get out of my situation. That's not true. Position sizing control and risk management can allow you to scale into positions gradually while controlling your risk so that you never expose more than 2% of your capital, and you can build quite a significant position as the market proves it right and gives you a chance to work within a trend. He says not only do you risk not getting repaired, so he's talking about repairing a car or a house, it's just too much. You will not succeed in trading if you are trying to trade with money that will cause you to get emotional when you lose it. And if you're in that position, your main goal right now should be to get out of that situation. Not necessarily talking about a trade. I'm talking about you need a plan so that you can get back to the point where all the funds you need for whatever that critical life thing is are still available to you with no more than a 2% risk. If you're not in there, you need to get to that point. I'm going to cover the next rule pretty quickly because it ties intimately to the last one, and then we're going to take a look at the position sizing calculator. So we have this rule number 6, always place a protective stop. To me, when I read that, that's the same thing as define your risk. If you are a trader, define your risk means always place a protective stop. The stop is what allows your position to get back to a point of safety when the market's moving against you. If you don't understand a stop or what it is, go to our YouTube channel, type in crypto stop losses. I did a video on Coinbase showing how to put a stop loss in using a limit order, giving yourself enough space so that it can execute. He says the single most understood rule in the trading game is the rule regarding the use of predetermined exit points, or as it's commonly stated in the industry, placing a stop loss order. Most traders use stop loss orders ineffectively at best. The most often heard complaint is that liquidating stops are elected right before the market continues further in the intended direction. How many of you put a stop on the chart, your position, and you let your position dictate where your stop was? So let's go take a look at Bitcoin as an example. I'm going to pull up the chart over here, and then I'll move my picture over. Okay, and I'm going to let's bring you all over to this chart here. Okay, so let me pull up a clean chart for a second and get the Coinbase chart up here. Here's our Coinbase chart of Bitcoin. How many of you have had the experience? It's okay if this is you. It's okay. Let's say, for example, you decide after letting Bitcoin trickle up, make a move, a significant move like this, you get FOMO'd in somewhere in here and you buy here. Okay, now let's take a look at what Bitcoin looked like right about there if we were to enter. You think, okay, this is enough of a swing back. This has got to be momentum building. It's going to make this kind of a move, maybe to square up over here looking left. That's where I would be looking. That's an ugly, let me do this a little bit better. Something like that. Even without doing retracement fibs or anything like that, just looking left, I see a point of resistance in the past. We've come up against this one here, and we've still got this one in the middle. Let's say we bought right here, and we decided to put a stop loss just underneath 50% of that candle in case they square up. Because I put in so much money at 7,900, I bought a whole Bitcoin at 7,900, and if I see this drop hit my account, I'm going to take an $800 loss, and that's a lot of money to me, and it's going to hurt. So I don't want to take more than $1,000. If this sounds like you, we've all been there. That's a very beginning type of mindset. I'm worried about that $800. I'm not thinking about percentages of capital. It just sounds like a raw number that would hurt to get hit with. Okay, so let's go forward a couple candles and see what happens. Okay, I got stopped out. So I took an $800 loss. And we'll say just about on 8,000. So that's about a 10% hit. We'll say we paid $8,000 for our Bitcoin. Let's make our example simple. We took an $800 loss at about 7,200. I can adjust this just a little bit for those of you sticklers in the back with your math. $800 loss on an $8,000 entry, 10%. And then what happens? What does the market do next? What's your instinct now? Well, now I'm losing my original entry, but maybe I was brave. Maybe I was patient. Maybe I waited. Uh-oh. Uh-oh. What are you going to do at this point? You're going to think you got left behind because you took that loss. Now you're going to come up here, and with your $7,200, you're going to try to put it all in there, and hopefully you're going to get a piece back when it keeps going. And then what happens? It never quite, it's going to tease you back and forth, and then you're just going to watch, sweat, worry. What's going to happen to my position? Is it ever going to, oh, I better get out. Well, maybe it's going to come back. Maybe I'll buy. If that's you, if you are letting your general feelings about an area on the chart get you into a position, you need to stop that behavior and start thinking about your position sizing. Your position sizing is more important. I'm going to say this very carefully because I don't want to offend anybody. If Scott's listening, I don't want to get him upset. Your position sizing is more important than your TA. Don't anybody go freak out on me. Don't anybody start a riot. Your TA is critical. It's one of your most important tools that you've got in your toolbox. It's how you decide certain plans around price action. But if you position size wrong in any of your trades, you set yourself up to not be able to sustain your trading in perpetuity. The entire goal of our game as traders is to be sustainable and to develop a positive flow of income. Yes, Taco, I'm not reading that out loud, but yes. So let's just take a look here at a clean chart for a second. And I'm going to go all the way to the present. And we're going to try to plan some kind of an entry with an amount of capital. So let's pretend for a moment that we're going to say that we're going to start with a modest $1,000 of capital. Now, I'm going to go into the portion of this lesson where I want to break down how to determine the maximum position I can buy of Bitcoin. This works for any of your USD pairs though, but in this example, it's going to be Bitcoin. What is the maximum position I can buy, given that I have $1,000 to trade with, and I need to stick to a 2% maximum risk on any given trade? Why 2%? 2% allows you to trade 50 times and be wrong 50 times before you go broke. It's a safety net. It's a protection. Later on, when you get more advanced and you're in different market conditions, you have a little flexibility in this percentage to work with on your own. But if you are a beginner starting out with trading and you want to survive long enough to be sustainably profitable, start with 2%. I strongly recommend it. It's very effective. I've tried it myself. It's worked for me, and I've listened to many other people have the same experience. When they switched to their capital being protected by the 2% rule, they significantly cut back on their losses. Because at the end of the day, your worst enemy is yourself. It's not the market. If you think the market is your enemy, you're going to lose this game. It's a very subtle distinction of perspective. But the market is only a reflection of your behavior within it. You're the one clicking the button. You're the one getting stressed and exiting on a loss. You're the one getting excited and not taking your profit off the table because you just got 2 times your money. Why would you stop now? The market did not do that. So if you have $1,000 of starting capital and you want to stick to the 2% rule, I'll share the link for this calculator. It's also in the Foundations training course on our website under the Protect Thy Capital lesson. This is the first position sizing lesson Excel sheet. It has a formula in it. It calculates based on an entry price you put in, a stop loss you decide. It tells you how much risk per coin you're dealing with. Based on whatever you put in for starting capital, it'll multiply it by the decimal of 2% and tell you how much risk of your capital is acceptable on any trade. Once you've entered all these parameters, this bottom formula down here is going to take your acceptable risk, your total acceptable risk, which divided by your risk per coin tells you what position size you can work with to stick to your 2% rule, given an entry and a stop loss of your choosing. I've also added a feature here where whatever your entry price is in USD value, it will multiply by the position size to tell you what the cost would be, in this case in USD. Of course, if you were to put a value that was New Zealand dollar or euro, it doesn't care what the denomination is, what the currency is. All it cares is the absolute value, matches of entry price and stop loss. So let's go back to our example here. We've got $1,000. Let's say we decide we can't take it anymore. We have to enter now before it runs away on us and starts the next bull run to the moon to 20,000 and beyond. Let's pretend for a moment we don't know the big picture. We don't have any concept of that. We're brand new, we're beginners, and we really just are itching to get into this market. Even if we're going to do that in a terrible spot and we're going to do it with ill intentions, if we stick to our position sizing rules, we can still protect our capital even against ourselves and our bad habits and our misunderstandings about what's going on in the marketplace. That's the beauty of the 2% rule. So we're going to enter at 72.95. We're just going to round it up. 72.95. That's our USD entry point. Notice it's already starting to pop some values in. We haven't put a stop loss in yet, so it's assuming it's 0. So let's go find a stop loss. Now let's say we're brand new. We don't think it's going to make a lower low. We think if it does that, it's sick and we need to get out. So let's say we're going to put our stop loss here. Oops, grab the wrong tool there. Sorry, y'all. We're going to put our stop loss here. Let's round it to 3,600. Now, this is me being pretty wise in giving myself a wide stop loss. Most new traders are not going to be on the day chart. They're going to be down on the 4-hour or the 1-hour chart, and they're going to do something like, I'm going to put my stop loss right here. I want a big position. I don't want to lose a lot of money. I'm going to put it real tight. But let's pretend we're smart. We're going to put it all the way down here, 3,600. Okay. So if your stop loss was 3,600, that means if you bought one Bitcoin at 72.95 and your stop loss gets hit at 3,600, your risk per Bitcoin in this example would be 36.95. Taking that into account against our acceptable risk of $20, your position that you should put on there for Bitcoin should be no larger than 0.005 Bitcoin, or about a $40 position. Now you might think to yourself, how in the world would I ever make money opening a $40 position on Bitcoin? Well, $40 of your $1,000 is actually a 4% gain. So my response to you would be, why are you paying attention to the absolute dollar value when a 4% gain in a single trade in a stock market is pretty respectable? Now in crypto, that's pretty sad to me. I don't think that's all that great. But if you were smart, you'd be waiting for them to come down here to give you an entry. You could put your stop loss up underneath with a small amount of range, and your amount that your position size can be goes up significantly. So let's pretend for a moment, just to see how that works, that we accept our stop loss here. We found there's a major support on this level. Just for example, please don't take that to the bank and think you can buy Bitcoin right now. But if there was a major support here at 63.50, if we could put our stop that much closer, notice now we can take a position that's significantly higher, $154 worth of Bitcoin, 0.021 Bitcoin, still maintain that we'll only lose $20 if our stop loss gets hit, but our position size is much larger because the distance between my stop and my entry is smaller. So what most traders do that is very backwards is they take the amount of money in their pocket and they decide, I think I'm okay putting this much money on the table, and if it gets losses to it, I'll decide when I'm going to get out based on how much the losses come in and how quickly. It's a very basic level of thinking. We all have to get there though. However, if you can turn it around and think based on an entry price with a stop loss that's in a technical spot on a chart that I like for reasons that matter to me, and given my starting capital that I can't lose more than 2% of on a trade, please tell me what my position size is. I am letting my risk parameter of 2% and my technical analysis of a good entry spot with a good stop decide how big my position can be. Brian says it only works on Bitcoin USD. No, this will work on any. So again, it doesn't matter what you put in here, whether it's a stock price or whether it's a New Zealand dollar price. It doesn't matter. Let's just say you bought, I don't know, a stock for $25 and you put a stop loss at $24.30 and your starting capital is $1,000. This still is going to tell you that you can buy 28.5 shares for a value of $700. And if that stop loss gets hit based on your entry of this position, your loss will be 20 bucks. You'll get out and you'll have maintained the 2% rule. It does not matter. The only caveat to that I will say is you should not use this for alt trades. I have a second calculator for that because alts take it a step further. You have to think about buying in Bitcoin. And generally, you want to know how much that's worth in fiat. So that's another step. And I'll do that in another lesson when I come back on my next night, which will be on Sunday the 12th, Eastern Standard Time. So again, just to kind of wrap it up and cap this lesson off, when you are deciding what your position size is going to be on any of your USD trades, your Bitcoin trades, your stock trades, any of those, you should have technical analysis that gives you an entry point and a stop loss. Once you have an entry point and a stop loss, you take that information combined with the amount of capital that you're trading with and working with. What's 2% of that? And those three parameters decide your position size. Just switching to this method of determining your position sizes will it will work wonders in your trading if you're not doing this already. And what it's going to do is it's going to stop you from taking more losses per trade than you should ever. Ray said, I was thinking that looked a bit different the last time I used that spreadsheet. Yes, there is a second one that I have, and I'll pull that one up for the next lesson. Simon says, I added to it to split my entries into 2 or 3 or 4 buys for scouting. Yes, and I have a lesson plan for that, but it's a little more advanced. It would be more source code material, but you can take this idea and you can break these down into halves, thirds, or quarters of entries, and then your risk goes down by halves, thirds, and quarters per entry, and you can scale in. So ultimately, your goal is to take an entry like this and get to where you can pull your stop loss up to your entry price. Because once you do that, your trade is at break even and it's risk-free. That's your main goal as a beginner. If you, as a beginner, can get a trade where you can get in here, price moves up and builds some support up here, maybe retraces and goes higher, and you get to the point where you can pull your stop loss up to that entry. Once your stop is equal to your entry, your risk per coin becomes 0. Once your risk per coin becomes 0, that position no longer poses any risk to your capital. If the market moves back down and hits your stop loss, you get out where you got in, and the only hit you take is in fees, which is minute compared to percentages of losses, generally speaking. Once you get to break even, now you have a new $20 of risk that's freed up that you can calculate a new position on another coin. The trick to that is make sure you only have so many open that you are able to keep track of. My personal rule is 3 at a time. and I've been doing this since 2017 for crypto and even longer for penny stocks. 3 at a time is enough for me to make significant gains. When one of them pops, I can roll it over to something else or take my risk off the table, enough to manage, and I'm able to put 2% into each one of those max. Now that means for me, if those are in positions that move together and they all get hit, I'm actually risking 6%. So sometimes I won't do a full position. I'll scale in a third to each one. So if they all get hit, my total is 2%. There's all kinds of ways that you can do this. There's 1,000,001 ways to skin a trade. What matters at the end of the day is that no matter what the market does, you're never taking more than 2% hit per trade, preferably on all of your trades in the beginning. But if you're in a couple of different things in a couple different places and they're moving independently, 2% per is not too bad. For me, I'm comfortable with that. I've gotten to a point personally where I'm comfortable with that, and that's okay. The last thing I will say with this lesson before I wrap it up and pass it to Scott so we can have a little bit of market coverage at the end of the room and wrap it up. Make sure that when you are planning your trades, you are planning an entry where the market comes to you. Don't jump into the market with your fingers crossed unless it's because the market just pulled back significantly to an area you were watching and you were waiting to jump in on that pullback. Don't jump in because the market moved away from you ever. If you can stick to that rule of not getting into the market when it moves in the direction you want it to go and waiting for it to come back to you, you are able to enter at a point where your stop is much lower than it would have been if you had entered at the top of that green candle. Your goal should be to get your stop at a comfortable point where if the market takes a big hit, you're not going to get stopped out unless that's part of your plan. You are in control of your plan, and you maintain that control by defining your risk through a stop loss of no more than 2% per trade, period. If you can handle that and you can do it with discipline, you have a long future of growing personally and growing financially in your ability to trade and invest in markets like crypto and all the rest of them that are available, because really this principle applies to any type of risk situation that you're dealing with financially. Why would you ever want to risk more than 2% of your assets in any one situation? That's the question I'll leave for anybody who's tapping into this recording or to this live room.
I can answer that for most people. They want to grow their account faster.
And again, the answer I always come back to is you want to grow your account faster, then you better stop letting it bleed.
Yep.
That's going to grow it faster than putting all your money on the table and hoping to hit a home run, hands down.